Good morning, hunters. Welcome back to the Daily Hunt for Multibaggers on this brisk Saturday, December 20th, 2025. We've been diving deep into the data collected yesterday, Friday, December 19th, and let me tell you, it was a busy one.
Absolutely, Ethan. We saw a significant increase in flagged posts across social media discussions, with quite a few different stocks popping up on our radar. It paints a very mixed picture out there. Some strong bullish sentiment, but also a healthy dose of skepticism.
Indeed, it feels like the market commentary is grappling between exciting growth stories and, well, some more cautionary tales. Let's dig in.
Let's start with Rivian Automotive Inc., or RIVN. We've discussed RIVN quite a few times, and it was flagged as a stay away as recently as December 19th. The user posts show some real optimism, with folks talking about plenty of upside left and love where the stock is going right now.
That's right, Brooke. There's definite community optimism around RIVN. With the stock recently showing some life and analysts like Wedbush and Canaccord maintaining buy or outperform ratings, even raising price targets. They're talking about 2026 being an inflection year for Rivian, and we've even seen robust insider buying of over 3.7 million shares in the last 6 months. That's a strong vote of confidence from within, suggesting future growth potential.
I hear you, Ethan, but the KPIs tell a different story. We're looking at a deeply negative net profit margin of negative 0.61 and earnings per share of negative 3.1. The debt-to-equity ratio is an alarming 102.28. While revenue growth is positive, that doesn't translate to actual profits, and the stock is trading near its 52-week high, despite these fundamental challenges. That suggests any gains might be driven by options activity or short-term sentiment, as some users pointed out, rather than a solid financial footing. Given its history of stay-away ratings, the current news and insider buying is a speculative bet on a future turnaround.
So despite the bullish analyst calls and insider confidence?
For me, the risks are too high. My final verdict for RIVN remains stay away.
Understood. Next up is Nebulous Group NV, or NBIS. We saw a post highlighting an $80,000 to $108,000 gain on NBIS calls, with users expecting the stock to be thooming next week. There's a lot of excitement around their AI Cloud 3.1 upgrade and general positive sentiment for the tech and AI sectors. It was a buy just over a month ago and a speculative gamble more recently.
Yes, the excitement is palpable, but again, the financials are concerning. NBIS has negative earnings per share, a negative operating margin, and a high debt-to-equity ratio of nearly 95%. While the AI cloud upgrade and strong sector tailwinds could certainly improve future revenue, this company is barely profitable right now, with a net profit margin of just 0.6%. That significant user bet on calls is purely speculative analysis, betting on future potential rather than current financial strength.
So you're saying the current bullishness is overlooking some foundational issues?
Exactly. For fundamental investors, this is a stay away. It's still a high-risk, high-reward play, perhaps.
All right, let's move to Intuitive Machines Inc., or LUNR. This one came up with Santa's gains were in space discussions, and a KeyBank analyst initiated coverage with an overweight rating and a $20 price target. We're seeing insider buying here too, about 2.76% of total shares, which hints at internal confidence.
While the space industry is exciting and KeyBank's call is noteworthy, LUNR's KPIs are very troubling. They have a deeply negative net profit margin of negative 0.94 and earnings per share of negative 2.46. The debt-to-equity ratio is an astronomical 152.25, and get this, a negative price-to-book ratio. That means their liabilities exceed their assets, which is a massive red flag. This has consistently been flagged as a stay away. That's a tough pill to swallow for a company in such a promising sector. Indeed, the potential future may be bright, but the current financial reality is stark. My verdict for LUNR is stay away. Okay, switching gears to a market darling, NVIDIA Corporation, NVDA. Social media discussions were all about how difficult it was to bet against NVDA, with comments regretting missed opportunities and acknowledging its massive surge in the AI gold rush. Bernstein maintains its long-term AI leadership. Jim Cramer is bullish, and they even got antitrust clearance for an Intel investment. We had it as a cautious buy recently. Even, I'll admit, NVDA is a different beast. While its price-to-earnings ratio of 449.72 and price-to-book ratio of 36.99 are very high, its fundamentals are exceptionally strong. We're talking about revenue growth of 0.625 and an incredible net profit margin of 0.53. Their return on equity is over 1.07. The insider selling we observed seems more like profit-taking after massive gains, not a lack of confidence. The market's high expectations are backed by real, tangible performance.
So even with those high multiples, you see the sustained growth potential?
Yes, the AI catalysts and market dominance are undeniable. The KPIs, while demanding a premium, actually support that premium through strong profitability and growth. My verdict for NVIDIA is an upgrade to buy. That's a big one. Now onto Palantir Technologies Inc., PLTR. The buzz was about an AI money dispenser, with a user boasting a 900% gain from 2021 to 2025. This historical performance, along with its strong AI focus, continues to draw attention. That historical success is impressive, Ethan, but we need to look forward. PLTR currently trades at an astronomical price to earnings of 449.72 and a price to book of nearly 70. While it has strong revenue growth at 0.628 and a healthy net profit margin of 0.28, those valuation metrics are simply extreme. The debt to equity is also a considerable 3.52, and we've seen slight net insider selling. The market is pricing in an unbelievable amount of future growth that may already be overstretched, as some news suggests. It was a stay away last time we checked.
So the past gains don't justify the current valuation?
Not for me. The risk of significant correction if those lofty expectations aren't met is too high. My verdict for PLTR remains stay away.
Up next, we have Rocket Lab Corporation, or RKLB. This stock was all over our feeds, with posts celebrating Santa's gains, talking about so much potential next year, and recent record contract wins. They secured an $816 million US contract and had successful launches for the Space Force. This one was a stay away last time. The community sentiment is indeed very bullish for RKLB, and those government contracts are certainly substantial. However, the KPIs are screaming caution. RKLB has a deeply negative net profit margin of negative 0.35 and earnings per share of negative 0.38, meaning it's still unprofitable. More critically, its price-to-book ratio is an incredibly high 27.32. This company is priced for perfection based on future potential, not current financial performance. And we've seen significant net insider selling, over 6 million shares in the last 6 months. That's a major red flag when those closest to the company are divesting while the public is so bullish. But with those big contracts, don't you think future KPIs could drastically improve?
They absolutely could, Ethan, but the current valuation already bakes in an immense amount of that future success. It leaves very little margin for error, and the insider selling suggests even they see the prices stretched. Until profitability is clearly established, it remains a highly speculative analysis. My verdict for RKLB is stay away.
Let's look at Carvana Co., CVNA. This one saw users betting against it with 36,000 CVNA puts, and some lamenting significant losses on bear bets, calling it a scam with a mountain of debt. It also got tagged as a stay away last time.
The bearish sentiment is overwhelming, and for good reason. CVNA has an extremely high price to earnings of 102.09, a massive debt-to-equity ratio of 192.40, and a price to book of nearly 28. Their net profit margin is a thin 0.03. To top it off, insiders have been net sellers, offloading almost 30% of their holdings in the last 6 months. User claims of cooked books or being a scam company, while strong, are heavily supported by these concerning metrics.
Even with discussions of potential S&P inclusion and recent marketing efforts?
Ethan, marketing and index inclusion are short-term drivers. They don't fundamentally address the extreme debt, the unsustainable valuation multiples, or the glaring lack of insider confidence. For me, the risks are profound. My verdict for CVNA is stay away.
And finally, CoreWeave Inc., or CRWV. The news was positive, joining the Department of Energy's Genesis mission and receiving a buy rating from Citi. Jim Cramer even expressed confidence in the CEO, saying the stock was up 20%. It was a stay away recently.
The news is certainly attractive, and AI cloud demand is a powerful tailwind. However, CRWV carries an extremely high debt-to-equity ratio of 485.03. It's deeply unprofitable, with a negative net profit margin and EPS. Users are questioning if they're burning money to bring capacity up. Most concerningly, insiders have been massive net sellers, reducing their holdings by over 32% in the last 6 months. This, combined with a 49% crash in 3 months prior, paints a picture of high risk and volatility.
So the positive news doesn't outweigh the financial and insider signals?
Not even close. The potential for future revenue from these contracts is there, but the current financial structure and insider behavior indicate extreme caution is warranted. My final verdict for CRWV is stay away.
So a lot to consider today. Let's round it up for our listeners. Investigate as buy, NVIDIA Corporation, NVDA. Investigate as cautious buy, none. Investigate as speculative gamble, Rocket Lab Corporation, RKLB. And that wraps up another edition of the Daily Hunt. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. Thanks for tuning in, everyone. We'll be back next time with more market commentary. Happy hunting!